Consumers expecting to spend about 10% less this year on holiday gifts for an average of nearly $1,600 as they prepare for higher prices, according to the latest Deloitte holiday retail survey. Our next guest warns that consumers are strapped. We could see a January hangover. Joining us is Unicus Ganapathi of Unicus Research. She's the founder and CEO of the short investment research firm. She's also worked closely with Steve Eisman, who is a friend of Fast Money, of course. Unicus, great to have you back. Good to see you.
Thank you for having me.
So you've been concerned about consumers and consumer credit for a while. What do you see happening in the past couple of months going into year-end that makes this thesis even more relevant?
Well, holiday season is on. Consumers are going to spend. And according to the latest statistics, 52% of the consumers are spending because of some obligation or guilt. But, they started shopping from August, some of them. It's more like not splurging. It's more value-driven and more guilt-driven than, splurging for a happy holiday season.
That sounds awful. I mean, that's
does.
really,
Yeah.
That is not the spirit.
It's not, but they are still doing it. 20 to 31% of the consumers who use credit cards for last year holiday spending, they are still paying off the debt. And they're going to stack up on it this year. So it's holiday cheer is on, but it's all on either BNPL or on credit card.
Okay, so how do you express this view in terms of stocks?
Well, stocks, BNPL companies like Affirm, Klarna, and other companies, they're going to be happy, something to be happy about, because consumers are using credit cards, and those who tapped out of credit cards, they are choosing BNPL. Like 30% are choosing BNPL to pay for holiday shopping. So in terms of stocks, it's more BNPL companies are going to do pretty well.
Auto loan delinquencies, I'm reading, the highest since 2000 and I want to say 10. Credit card, the highest in 14 years, 7.1% delinquencies. Nobody seems to care. The market's sort of looking at this and saying it's not a big deal yet. When does it become a big deal?
Well, there is going to be a hangover in first half of 2026. And this happens when the layoffs are started to pile up in 2025, more than 1 million layoffs. And if this labor market keeps softening up into the 2026, we will see delinquencies and charge-offs to spike up in auto loans and credit cards.
So are you seeing a bifurcation in the wealthier customer versus the wealthier shopper versus the lower end shopper, that where the upper level shopper is actually concerned about layoffs, maybe even more than the lower end?
Definitely. I mean, last quarter we saw through Dollar Tree and Dollar General that people who are making more than 100,000 are trading down to shop at discounted places like Target, Walmart, and Dollar Tree. So yeah, the consumers across the board are very concerned, and near prime consumers are facing a lot of delinquencies in terms of auto loan and credit cards.
So near prime is like what household income approximately?
Roughly 100K and like 200K,
so
in that range.
Consumer.
It's yes.
So bring it back, though, to buy now, pay later and those others. It sounds to me that the story you're setting up is, in the short run, it's great for them, but as we get further out, it's a disaster.
It is a
and
disaster.
They seem to be often targets on the short side.
It's like kicking the can down the road. And, it's a whole different conversation when we talk about buy now, pay later. They are being funded by private credit. So the money is a lot over there. So it's going well. And we don't know how strict they are in trying to recoup the delinquent consumers. But so far, it seems to go fine with BNPL.